September 15th, 2008, 1:45 in the morning. In a Manhattan skyscraper, lawyers were preparing the largest bankruptcy filing in American history. By sunrise, Lehman Brothers, a financial institution that had survived the Civil War, 2 world wars, and the Great Depression, would be dead. 158 years of history erased in a single weekend. The filing listed $613 billion in debts, but that number doesn't capture what really happened. Because when Lehman fell, it triggered a cascade that would destroy $10 trillion in global wealth within months. $10 trillion. That's roughly the entire economic output of China at the time, just gone. Within days, the stock market would plunge 778 points in a single session, the largest point drop in history. Retirement accounts were slashed in half. Unemployment would eventually hit 10%. 8 million Americans would lose their homes to foreclosure. But here's what makes this story different from every other financial disaster. This wasn't a natural catastrophe. This wasn't a random economic downturn. This was engineered, built deliberately over decades by people who knew exactly what they were doing. They created exotic financial instruments with names like collateralized debt obligations and credit default swaps. They bundled bad loans with good ones and sold them as safe investments. They bet billions on assets they knew were worthless. And when regulators tried to intervene, they spent millions lobbying to keep the casino open. The question everyone asked afterwards was simple. How did this happen? How did the smartest people on Wall Street, with their Ivy League degrees and sophisticated computer models, not see this coming? The truth is darker than incompetence. They saw it. They just didn't care. Because in the years leading up to the collapse, they were making too much money to stop. This is the story of how American capitalism nearly destroyed itself. This is the story of the 2008 financial crisis. To understand how the global economy nearly collapsed, you need to understand where this began. And it started in the most American place imaginable, with the dream of owning a home. For decades, getting a mortgage was straightforward. You walked into a bank, proved you had steady income and good credit, and if you qualified, they loaned you money. The bank kept that loan on their books for 30 years. If you defaulted, they lost money. Simple, safe, boring. But in the 1990s, Wall Street figured out how to turn boring into profitable. They invented something called securitization. Here's how it worked. Instead of banks keeping mortgages on their books, they could sell them to investment banks. Those investment banks would bundle thousands of mortgages together and sell them as securities to investors worldwide. Suddenly, the bank that gave you a mortgage didn't care if you could actually pay it back. They were going to sell it to Wall Street within weeks anyway. The risk moved from Main Street to Wall Street, then from Wall Street to investors around the globe. At first, this seemed brilliant. Banks could make more loans because they weren't tying up their capital. Investors got a steady stream of income from mortgage payments. Home ownership rates climbed. Everyone won. But then came the fatal innovation. Investment banks realized they could make these mortgage-backed securities even more profitable by dividing them into different tranches, different levels of risk. The safest tranches, made up of the most reliable mortgages, were rated AAA by credit rating agencies. The riskiest tranches, filled with subprime mortgages from borrowers with terrible credit, were rated much lower. Here's where greed entered the equation. Those AAA-rated tranches didn't pay much interest because they were considered so safe, but there was enormous demand for safe investments from pension funds, insurance companies, and foreign governments, so Wall Street needed more AAA-rated securities to sell. The solution was diabolical in its simplicity. Take those risky subprime mortgages, bundle them with better mortgages, run them through complex mathematical models, and somehow, magically, the rating agencies would declare large portions of these bundles to be AAA rated, safe as government bonds, safe as cash. Except they weren't safe. They were toxic. But the rating agencies, Moody's, Standard & Poor's, Fitch, they were paid by the very banks creating these securities. If they didn't give good ratings, the banks would take their business elsewhere. So they gave AAA ratings to securities that would later prove worthless. By 2005, the mortgage machine was running at full throttle. But there was a problem. Wall Street's appetite for mortgages was insatiable. They needed more loans to bundle and sell. Many more. The solution was to lower lending standards. Dramatically. Banks began offering what they called ninja loans. No income, no job, no assets. You could get a mortgage by simply claiming you earned enough to pay it back. No documentation required. Stated income loans, liar loans. They offered adjustable rate mortgages with teaser rates, artificially low interest rates for the first 2 years, then massive increases afterwards. They offered interest-only loans where you paid nothing toward the principal. They offered negative amortization loans where your debt actually grew larger every month. Mortgage brokers weren't paid to find qualified borrowers, but they were paid commissions based on volume. The more loans they originated, the more money they made. So they put people into homes they couldn't afford, into loans they didn't understand, with terms that guaranteed they would eventually default. In California, Florida, Nevada, and Arizona, home prices were skyrocketing. People were buying houses not to live in, but to flip for quick profits. Speculation was rampant. A stripper in Nevada testified she owned 5 properties. A strawberry picker in California purchased a $720,000 home. The conventional wisdom was that home prices would keep rising forever. They'd never declined nationwide before. Even if individual borrowers defaulted, the banks could just seize and sell the homes for a profit. But this belief, this assumption that home prices would always rise, this was the foundation upon which the entire financial system was now built. And foundations built on delusion always crack. Between 2000 and 2007, something extraordinary happened to Wall Street. The big investment banks, Goldman Sachs, Morgan Stanley, Merrill Lynch, Lehman Brothers, Bear Stearns, they didn't just grow, they metastasized. In 2000, the 5 largest investment banks held $1.2 trillion in assets. By 2007, that number had grown to $4 trillion. But here's the disturbing part. They did this using borrowed money, massive amounts of borrowed money. Investment banks operate on something called leverage. For every dollar of their own money, they borrowed additional dollars to make bigger bets. In the 1990s, investment banks typically operated at 12-to-1 leverage, 12 borrowed dollars for every dollar they owned. But in 2004, the Securities and Exchange Commission made a decision that would prove catastrophic. They changed the rules to allow investment banks to calculate their own leverage ratios using their own risk models. This was like letting gamblers decide how much money they could borrow to make bigger bets. By 2007, the major investment banks were operating at leverage ratios of 30-to-1, some even higher. Bear Stearns reached 35-to-1. This meant that if the value of their assets declined by just 3%, they would be wiped out, completely insolvent. But the profits were extraordinary. In 2006 alone, Goldman Sachs paid out $16.5 billion in compensation to its 26,000 employees. The CEO, Lloyd Blankfein, took home $54 million. At Lehman Brothers, CEO Richard Fuld earned $485 million between 2000 and 2007. The engine driving these profits was the mortgage-backed securities market. But as demand grew, Wall Street invented something even more complex and dangerous: collateralized debt obligations, CDOs. Here's how they worked. Take those lower-rated tranches of mortgage-backed securities, the riskier portions that didn't get AAA ratings, bundle them together into a new security, run them through mathematical models again, and somehow, through financial alchemy that even the people creating them didn't fully understand, large portions of these repackaged securities would receive AAA ratings. It was absurd. You were taking the garbage, the riskiest parts of mortgage pools, and claiming that by mixing garbage together, you'd created gold. But the rating agencies signed off on it. Investors bought them, and Wall Street made billions in fees. And then came the CDO squared. This was a CDO made up of tranches from other CDOs. And then, unbelievably, the CDO cubed. These were so complex that the banks selling them couldn't explain how they worked. One trader later testified that the mathematical models used to value CDOs ran to over 200 pages of equations. But complexity was the point. The more complicated the security, the more investors had to trust the ratings agencies and the bank's risk models, and the more fees the banks could charge. By 2006, banks were creating $225 billion worth of CDOs annually. Most of them were packed with subprime mortgages, and most of them were rated AAA, but the mortgage market was running out of borrowers. So Wall Street created synthetic CDOs. These didn't even contain real mortgages. They were essentially bets on whether existing mortgage-backed securities would succeed or fail. It was like creating fake horse races so gamblers could make more bets. One hedge fund manager, John Paulson, realized something the banks apparently didn't care about. These securities were garbage. The underlying mortgages were given to people who would inevitably default. The whole system was built on a lie. So Paulson did something brilliant. He bet against the housing market using credit default swaps. A credit default swap is essentially insurance on a bond or a security. You pay regular premiums, and if the security defaults, you receive a massive payout. Investment banks like Goldman Sachs and Morgan Stanley were happy to sell these swaps. They were collecting premiums like an insurance company, and they were convinced the securities would never default. Paulson spent millions buying credit default swaps on the most toxic mortgage securities he could find. To the banks selling him these swaps, he looked like a fool. Why would anyone bet against the housing market when home prices had been rising for years? But Paulson had done the math. He'd read the mortgage documents. He'd seen the NINJA loans, the negative amortization loans, the adjustable rate mortgages that would reset to unaffordable levels. He knew that when those interest rates adjusted, millions of borrowers would default simultaneously. Other investors noticed too. Michael Burry, a hedge fund manager who wore shorts and t-shirts to meetings and had a glass eye, spent months analyzing thousands of individual mortgages inside mortgage-backed securities. What he found horrified him. The loans were fraudulent. Borrowers had lied about their income. Brokers had falsified documents. Appraisers had inflated home values. Burry started buying credit default swaps in 2005. The banks thought he was crazy. His own investors thought he was crazy. For 2 years, he watched the premiums drain his fund while housing prices kept climbing. But in early 2007, the first cracks appeared. February 2007. A small subprime lender called New Century Financial announced it was facing bankruptcy. New Century had been one of the largest subprime mortgage originators in the country. In 2006, they'd issued $51 billion in loans. Now they were revealing that borrowers were defaulting at alarming rates. The mortgages they'd sold to Wall Street, mortgages they'd claimed were sound, were going bad, fast. Wall Street barely reacted. New Century was a small player. The overall market was still strong. Home prices were still rising in most areas. And this was just one company with poor risk management. But inside the financial system, people were starting to panic. At Bear Stearns, 2 hedge funds that invested heavily in mortgage-backed securities were hemorrhaging money. By June, they'd lost $1.6 billion. The funds had been leveraged 10-to-1, amplifying losses. Bear Stearns tried to hide the damage, but by July, they had to shut down both funds. Still, Wall Street remained confident. These were isolated incidents. The fundamentals were sound. The model said so. In August 2007, a French bank called BNP Paribas froze redemptions on 3 investment funds worth $2.2 billion. They announced they couldn't value the mortgage-backed securities the funds held because the market for them had disappeared. There were no buyers. The securities were illiquid. This was the moment the music stopped. Banks around the world suddenly realized they were holding assets they couldn't value and couldn't sell. Worse, they didn't know which other banks were holding toxic securities. Trust, the foundation of the financial system, evaporated overnight. Banks stopped lending to each other. The credit market seized up. The interest rate that banks charge each other for overnight loans, normally a fraction of a percent, spiked to over 6%. Banks were hoarding cash, terrified they might need it to cover their own losses. The Federal Reserve, led by Chairman Ben Bernanke, began emergency interventions. They injected billions into the banking system to keep credit flowing, but the crisis was accelerating. In September 2007, there was a run on a British bank called Northern Rock. Customers lined up outside branches to withdraw their savings after the bank announced it had sought emergency funding from the Bank of England. It was the first bank run in Britain in 140 years. The government eventually had to nationalize the bank to stop the panic. Back in the United States, the Federal Reserve cut interest rates dramatically, trying to stimulate the economy and provide relief to borrowers with adjustable rate mortgages. But it wasn't enough. Home prices had peaked in 2006 and were now falling. By late 2007, they were down 5% nationally. In cities like Las Vegas and Phoenix, they'd dropped 15%, and they were accelerating downward. This was the nightmare scenario the entire financial system had dismissed as impossible. Falling home prices meant rising defaults. Rising defaults meant mortgage-backed securities were losing value. And because these securities formed the foundation of trillions in CDOs and other complex instruments, losses were spreading like contagion through the entire global financial system. Borrowers with adjustable rate mortgages were seeing their payments double or triple as teaser rates expired. Millions couldn't afford the new payments. They tried to refinance, but with home prices falling, they were underwater, owing more than their homes were worth. Banks wouldn't refinance underwater mortgages. The only option was default. Walk away, let the bank foreclose. By early 2008, foreclosure rates were spiking. In states like California, Florida, Nevada, and Arizona, the states that had seen the biggest housing bubbles, foreclosures were up 100%, even 200% from the previous year. Banks were seizing homes, but they couldn't sell them. The market was flooded with inventory. Every foreclosure drove home prices down further, triggering more defaults in a vicious cycle. The rating agencies that had stamped AAA ratings on all those mortgage-backed securities and CDOs were now frantically downgrading them. Securities that had been rated AAA in 2006 were suddenly rated junk by 2008. Pension funds and investors who'd bought these securities thinking they were safe were suffering catastrophic losses. In March 2008, the crisis claimed its first major Wall Street victim. Bear Stearns, one of the oldest and most prestigious investment banks, was on the verge of collapse. They'd lost billions on mortgage-backed securities and CDOs. Other banks refused to lend to them. They were hours from bankruptcy. The Federal Reserve engineered a rescue. They provided $30 billion in guarantees and arranged for JP Morgan Chase to purchase Bear Stearns for just $2 per share. 1 year earlier, Bear Stearns stock had traded at $170. The message was clear. If Bear Stearns, a firm that had survived 85 years, could collapse in days, no one was safe. Treasury Secretary Henry Paulson, a former CEO of Goldman Sachs, tried to calm markets. He declared the banking system was sound. The worst was behind us. He was catastrophically wrong. Summer 2008. The financial system was dying, but the patient didn't know it yet. Stock markets were down, but not catastrophically. Some analysts were calling a bottom in housing. Maybe the worst was over. Then came September 7th, 2008. The federal government seized Fannie Mae and Freddie Mac, two massive mortgage finance companies that owned or guaranteed $5 trillion in mortgages. Together, they backed nearly half of all outstanding home loans in America. Both companies were insolvent. They'd lost tens of billions on bad mortgages. Without a government takeover, they would collapse, and the entire mortgage market would freeze. The rescue was the largest government intervention in private industry in American history, but instead of stabilizing markets, it terrified them. If Fannie and Freddie needed rescue, how many other institutions were secretly insolvent? The answer came fast. Lehman Brothers, the fourth largest investment bank in America, was hemorrhaging. They'd invested heavily in commercial real estate and held $60 billion in mortgage-backed securities and CDOs. As real estate values plunged, those assets were worth far less than Lehman claimed. Short sellers were attacking the stock, driving it down. Lehman's CEO, Richard Fuld, tried desperately to find a buyer. He approached Bank of America, Barclays, and others. But when potential buyers examined Lehman's books, they found a disaster. The losses were far bigger than Lehman had disclosed. By September 12th, Lehman was out of options. The Federal Reserve and Treasury Department assembled Wall Street CEOs for an emergency weekend meeting. The message: find a solution, or Lehman collapses on Monday. Throughout that weekend, the CEOs, representing Goldman Sachs, Morgan Stanley, Citigroup, JP Morgan Chase, and others, negotiated. Could they pool resources to save Lehman? The British bank Barclays wanted to buy Lehman, but the British government refused to approve the deal without American guarantees. Treasury Secretary Paulson made a fateful decision. After rescuing Bear Stearns and taking over Fannie and Freddie, he worried about moral hazard. If the government kept bailing out failed institutions, why would banks ever act responsibly? Paulson drew a line. No government rescue for Lehman Brothers. Sunday night, September 14th, the meeting ended without a solution. Lehman would file for bankruptcy in the morning. At 1:45 a.m. on September 15th, Lehman Brothers filed for Chapter 11 bankruptcy. It listed $639 billion in assets and $613 billion in debt. It was the largest bankruptcy filing in American history. By the time markets opened Monday morning, the contagion had spread. Merrill Lynch, another storied investment bank, was hours from collapse. They negotiated a desperate emergency sale to Bank of America for $50 billion, a fraction of what they'd been worth a year earlier. AIG, American International Group, the largest insurance company in the world with $1 trillion in assets, was on the brink. AIG had sold hundreds of billions in credit default swaps, essentially insurance policies on mortgage-backed securities. When those securities collapsed, AIG owed massive payouts it couldn't cover. On September 16th, the Federal Reserve provided an $85 billion emergency loan to AIG, taking an 80% ownership stake. If AIG failed, it would trigger the collapse of dozens of major banks worldwide that had bought its credit default swaps. The stock market was in freefall. On September 29th, the Dow Jones plummeted 778 points, the largest single-day point drop in history. Nearly $1.2 trillion in market value vanished in hours. The credit markets were frozen. Banks stopped lending entirely. Companies couldn't get short-term loans to make payroll or buy inventory. The commercial paper market, which businesses rely on for day-to-day operations, had ceased to function. The money market funds, supposedly the safest place to park cash, were breaking the buck, meaning investors were losing money. People were rushing to withdraw savings. The entire financial system was hours from total collapse. Inside the Treasury Department, Secretary Paulson and Fed Chairman Bernanke realized they were staring at another Great Depression. Except this would be worse, because the modern economy was completely dependent on credit. If credit froze, everything stopped. Payroll, inventory, trade, everything. They needed emergency action on a scale never attempted before. On September 19th, Paulson went to Congress with a 3-page proposal. He wanted $700 billion to buy toxic assets from banks. He wanted the authority to spend this money however he saw fit, with no oversight, no limits, and no judicial review. He called it the Troubled Asset Relief Program, TARP. Congress was appalled. Why should taxpayers bail out Wall Street executives who'd caused this disaster? Paulson had earned $700 million as Goldman Sachs CEO before becoming Treasury Secretary. Now he wanted to use public money to rescue his former colleagues. On September 29th, the House of Representatives voted down the TARP proposal. The stock market crashed 778 points in response, the same day they'd plunged 778 points before. The message was clear: pass TARP or watch the financial system die. Congress reconsidered. On October 3rd, the Senate passed a revised version of TARP. The House followed. President George W. Bush signed it into law immediately. But even $700 billion wasn't enough to stop the panic. The crisis was spreading globally. Iceland's entire banking system collapsed. The British government had to nationalize multiple banks. European governments were creating their own bailout programs. By October 2008, global stock markets had lost $8 trillion in value. By March 2009, the losses would exceed $10 trillion. A decade of gains erased in 6 months. The real economy was collapsing too. In September 2008, the unemployment rate was 6.1%. By October 2009, it would hit 10%. The economy would lose 8.7 million jobs. Another 8 million workers would see their hours cut to part-time. Retirement accounts were devastated. Americans lost $2.8 trillion in retirement savings. People in their 60s who'd planned to retire watched their 401ks cut in half. The housing market was in free fall. By 2009, home prices had dropped 33% from their 2006 peak. Homeowners had lost $7 trillion in home equity. Millions were underwater, owing more than their homes were worth. And the foreclosures were just beginning. Between 2007 and 2012, American banks foreclosed on 4 million homes. Another 2 million homeowners faced foreclosure proceedings. Entire neighborhoods were gutted. In cities like Detroit, Phoenix, and Las Vegas, vacant homes stretched for blocks. The human toll was staggering. Families who'd lived in their homes for decades lost everything. Retirement savings gone, credit destroyed, forced to move into rental apartments or, in some cases, homeless shelters. But what about the people who caused the crisis? What about the CEOs, the traders, the mortgage brokers who'd profited from the bubble? The answer is as infuriating as it is predictable. Almost nothing happened to them. Let's start with the executives. Richard Fuld, the CEO of Lehman Brothers, walked away with $485 million in compensation earned between 2000 and 2007. After Lehman collapsed, destroying 25,000 jobs and wiping out billions in shareholder value, Fuld faced no criminal charges. Stan O'Neill, CEO of Merrill Lynch when it collapsed, was forced out with a $161 million severance package. Chuck Prince, CEO of Citigroup, which required $476 billion in government guarantees and bailouts to survive, resigned with $68 million in stock holdings and a pension. These men made fortunes building the bomb. When it exploded, they walked away rich. But surely the government prosecuted the fraud, right? The liar loans, the fraudulent appraisals, the falsified documents. Here's the reality. After the savings and loan crisis of the 1980s, the federal government prosecuted over 1,000 people. More than 800 went to prison, including top executives. After the 2008 financial crisis, a disaster 70 times larger, the Department of Justice prosecuted one major Wall Street executive for crimes related to the mortgage crisis. One. His name was Karim Saragoldin, a Credit Suisse executive who pleaded guilty to inflating the value of mortgage bonds. He served 30 months in prison. That's it. That's the entire list. Why? The official explanation was that while behavior was reckless, unethical, and destructive, it wasn't technically illegal. The banks had armies of lawyers structuring deals to stay within the letter of the law, even when they were clearly violating its spirit. But there's another explanation: political capture. Between 1998 and 2008, the financial industry spent $5.1 billion on lobbying and campaign contributions. They'd spent decades systematically dismantling the regulations that might have prevented the crisis. The Glass-Steagall Act, which separated commercial banking from investment banking, was repealed in 1999 at the urging of Wall Street and with the support of both Democratic and Republican politicians. The Commodity Futures Modernization Act of 2000 explicitly exempted credit default swaps from regulation. This was the instrument that destroyed AIG and nearly collapsed the global financial system. Congress had voted to ensure no one could regulate it. When Brooksley Born, head of the Commodity Futures Trading Commission, tried to regulate derivatives in 1998, she was shut down by Treasury Secretary Robert Rubin, Fed Chairman Alan Greenspan, and SEC Chairman Arthur Levitt. All three warned that regulation would harm innovation and damage the economy. They were catastrophically wrong, but they faced no consequences. The credit rating agencies, Moody's, Standard & Poor's, Fitch, faced no criminal prosecution despite knowingly rating junk securities as AAA. They paid some fines. Moody's settled with the Department of Justice for $864 million. Standard & Poor's paid $1.5 billion. Compare those fines to the profits they'd made. In 2006, at the height of the bubble, Moody's reported a 48% profit margin. Their stock price quadrupled between 2000 and 2007. The fines were just a cost of doing business. The banks themselves paid larger fines and settlements. Bank of America paid $16.65 billion. JP Morgan Chase paid $13 billion. Citigroup paid $7 billion. Goldman Sachs paid $5 billion. In total, major banks paid over $150 billion in settlements related to the financial crisis. But none of these settlements required executives to admit wrongdoing, and none of the money came from the executives personally. It came from shareholders. The bank's CEOs continued earning millions. Lloyd Blankfein at Goldman Sachs, Jamie Dimon at JP Morgan Chase, Brian Moynihan at Bank of America all kept their jobs, all continued taking home massive compensation. Meanwhile, what happened to the homeowners who'd been deceived into taking toxic mortgages? Some received modest settlements, $300, maybe $500, as part of class action lawsuits. A tiny fraction of what they'd lost. The TARP program, the $700 billion bailout, was technically repaid with interest. The government made a profit on paper. Banks point to this as proof the bailout worked, but this ignores the hidden subsidies. The Federal Reserve dropped interest rates to near zero and kept them there for years. They purchased $3.5 trillion in mortgage-backed securities and treasury bonds through quantitative easing. This provided enormous benefits to banks, while devastating savers and retirees who depended on interest income. Congress did pass the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. It created the Consumer Financial Protection Bureau, imposed stress tests on major banks, and required higher capital reserves. But the financial industry immediately began lobbying to weaken these regulations. They spent millions on lawyers and lobbyists to delay, dilute, and dismantle the new rules. By 2018, Congress had rolled back significant portions of Dodd-Frank. The truth is, the crisis revealed something uncomfortable about American capitalism. When profits are privatized but losses are socialized, when executives get rich during booms but taxpayers cover the losses during busts, you create a system that incentivizes reckless behavior. The banks were too big to fail. Everyone knew it. The government knew it. The banks knew it. And knowing they'd be rescued, they took bigger risks, made bigger bets, and collected bigger bonuses. 16 years have passed since Lehman Brothers filed for bankruptcy. The economy recovered. Stock markets reached new highs. Housing prices rebounded and in many cities exceeded pre-crisis levels. But what did we actually learn? The financial system is larger and more concentrated than before. The 5 biggest banks now control assets equal to 60% of the American economy. In 2007, before the crisis, that number was 43%. We responded to too big to fail by making the banks bigger. The instruments that caused the crisis, mortgage-backed securities, CDOs, credit default swaps, they still exist. They're still traded. The markets for these products are smaller and more regulated, but the fundamental structures remain. And the wealth inequality that contributed to the crisis has only accelerated. In 2007, the top 1% of Americans held 23% of all wealth. Today, they hold 32%. The middle class hasn't recovered what it lost. Real wages adjusted for inflation have barely budged for most workers since 2008. Meanwhile, Wall Street compensation has fully recovered. In 2021, employees at major investment banks received $75 billion in bonuses. Goldman Sachs CEO David Solomon earned $35 million in 2021 alone. The fundamental lesson of 2008 should have been simple. Unchecked greed, combined with complex financial engineering and regulatory capture, creates systemic risk that threatens the entire economy. But the real lesson we learned is darker. You can destroy the global economy, cost millions of people their jobs and homes, and walk away rich. You can commit fraud on a massive scale and face no consequences. You can lobby to prevent regulation, take excessive risks, and then demand taxpayers bail you out when things collapse. This isn't a lesson about economics. It's a lesson about power. The 2008 crisis revealed that the financial industry had become so powerful, so essential to the functioning of the economy, that it was essentially untouchable. They could dictate terms to the government. They could avoid prosecution. They could use public money to cover private losses and then fight regulations designed to prevent future crises. Are we vulnerable to another crisis? Absolutely. The warning signs are eerily familiar. Housing prices in many cities have reached unsustainable levels. Private equity firms are buying rental properties with highly leveraged debt. Commercial real estate is facing a potential collapse as remote work reduces office demand. Student loan debt has reached $1. $7 trillion, much of it packaged into securities similar to the mortgage-backed securities that caused the 2008 crash. Corporate debt is at record highs. And climate change, an entirely new systemic risk, threatens to destabilize insurance markets, coastal real estate values, and agricultural production. The tools that the Federal Reserve used to combat the 2008 crisis, dropping interest rates to zero, purchasing trillions in assets, won't be as effective next time because interest rates started from a low base in recent years. But perhaps the most concerning element is this: we've normalized bailouts. The government rescued airlines, hotels, and countless other industries during the COVID-19 pandemic. The lesson to corporations is clear. Take risks, and if things go bad, the government will rescue you. This creates a system where failure has been eliminated for the powerful, but remains devastating for everyone else. Where homeowners face foreclosure, but banks receive bailouts. Where workers lose jobs, but executives receive bonuses. Where students drown in debt, but banks profit from securitizing their loans. The 2008 financial crisis was supposed to be a wake-up call. A moment when we fundamentally rethought how we regulate finance, how we balance innovation with stability, how we hold powerful institutions accountable. Instead, it became a masterclass in how power protects itself. September 15th, 2008 didn't have to happen. The crisis wasn't a natural disaster. It wasn't inevitable. It was engineered by people making conscious decisions to prioritize short-term profit over long-term stability, to prioritize personal wealth over systemic risk. They knew subprime mortgages were failing. They knew the ratings were fraudulent. They knew the leverage was unsustainable. They knew $10 trillion in wealth destroyed, 8 million jobs lost, 4 million homes foreclosed, millions of lives upended, and the people responsible faced no consequences. If that doesn't make you angry, you haven't been paying attention. The question isn't whether another crisis will happen. The question is when. And when it does, will we finally demand accountability? Or will we bail out the banks again, let the executives keep their bonuses, and move on as if nothing fundamental needs to change? The 2008 financial crisis taught us what happens when greed meets complexity meets regulatory capture. It showed us that the system is designed to protect those at the top, no matter how much damage they cause. The real question is, are we going to do anything about it? If you found this documentary eye-opening, hit that subscribe button. We dive deep into the corruption, greed, and power structures that shape our world. Next time, we're investigating another financial scandal that will make this one look tame. Because the truth is, 2008 wasn't an exception. It was a preview. Thanks for watching. And remember, follow the money. It always tells the real story.